Just give a moment for everybody to join in. Okay, I'd like to welcome everybody to our seminar here. It's being put on a combined presentation with CA Protect and Desjardins. My name is Jarrett Thompson. I'm the managing director for CA North and East Ontario, as well as the principal for CAA Protect. I'm glad to be able to introduce Brent Swatuk and DeWitt Hamilton from Desjardins. They're going to be talking about a whole bunch of different things about life insurance, retirement, and estate planning. If you have questions, there's a button at the bottom where you can put questions in the chat. What we'll do is we're going to keep all of those questions because some of the questions they're going to answer in their presentation. And at the end of the presentation, if we have some time left, we'll answer questions. But what we'll do is we can only answer questions that are general in nature. If it's a very specific question, it might be something that you have to talk to one of our advisors about. And at the end of the presentation, you'll be getting an email with some contact information if you want to follow up or have any specific questions that we can help you with. And at this point, I am going to pass things over to Brent and DeWitt.
Fabulous. Thank you, Jared. You can hear me?
We can hear you.
Fabulous. So thank you. And folks, we'll kind of go through my opening slides a little bit faster just so we can keep you on track and get in. Besides, DAWIT's really the main attraction in tonight's event. So I will try and speed a couple of things along. My name is Brent Swatuk. I'm the Regional Vice President for Ontario and Atlantic Sales for Desjardins Insurance. And I've been in the business for just about 30 years, the last 25 working on estates and working with business owners exclusively in the emerging high net worth and high net worth space. I'm pleased that I've got DeWitt Hamilton joining me. You're going to see a whole slew of designations behind DeWitt's name, and that's because he's committed to professionalism. DeWitt's on our team since 2009. He's one of our lead advanced planning specialists. He's known for taking complex situations and making them very simple and turning them into actionable items that Canadians can take and their advisors can take in order to better prepare their estates and to make sure that they transfer them through with the maximum amount of efficiency. DeWitt gets asked to speak at a lot of industry events as a keynote speaker. So we're very fortunate that he could free up some time to spend with you folks tonight. And as I said, his real specialty is taking complex and turning it into clarity and actionable steps. He does hold a BA from Brock University. That first CFP, that's Certified Financial Planner. The next is Chartered Life Underwriter. That's working with business owners and estates. The next one is Certified Health Specialist. And the last one is Trust and Estate Practitioner. So without further ado, well, actually, I'm going to do the next slide too. So let's move on to the next one.
Yeah, we'll move on.
Yeah, the next one is our standard disclaimer. It just basically says that we're not getting into anything too majorly complex here. But basically, if you live outside of a province that we talked in, your tax jurisdiction may be slightly different when it comes to probate taxes. So, what we ask is, and as Jared said in the beginning, if there is something very specific that you're looking to get, you're probably going to want to get independent on advice. But for this presentation, we're going to do our best to make sure that we've crossed all our T's, dotted all our I's, and that for what we're going to present, everything is true. And we do have a lot of things in our agenda here, folks, so we will move rather expeditiously throughout the presentation. The first one we're going to talk about is the life cycle of understanding term life insurance and where it fits. And we're going to go through a bit of a case study and talk about how things have evolved in life insurance. And for some of you, I can't see your lovely faces. For some of you might say, well, I'm past that stage in life. And so that may be more applicable maybe for your kids. And for some of you, it may be exactly where your stage in life is. And I think we've got some interesting solutions there and how they morph and evolve over time. The next one is solving the estate tax problem. So there, as we build wealth, there's lots of interesting things that happen. And then obviously at the end of the day, the tax man would like a little bit. So DeWitt's going to share some examples on that. We've got the next one is looking at the old style retirement plan versus the new and making sure that it's bulletproof to hold you and sustain you through that last period of life. And then at the end, what we're going to do is we're going to take you through a summary of all the concepts that we've shared with you this evening. So now, without further ado, I'm going to turn it over to DeWitt. I will be joining him throughout the presentation with maybe some quips and ideas, but for the most part, we're fortunate to have DeWitt with us this evening.
Great. Thank you, Brent, and thanks for Jerry and the team and everyone for having me today. Brent, you can hear me okay?
Perfectly.
Awesome. Great. Okay, so as Brent mentioned, we have a lot of different topics to cover throughout the next little while or so. Our goal, of course, is to take away some, if you learn some ideas that we've talked about in the next little while, just speak with your advisors and I'm more than happy to sit down and walk you through that. So let's just start with the basics here. Term life insurance. I know most of you know what term life insurance is, but I just want to kind of recap what it is so that we're on the same level. Certainly, it's life insurance that covers for a specific period of time. So, for example, you could cover for you for 10 years, 15 years, or 20 years. And the premiums are actually guaranteed for that specific period of time. So let's say you purchase a term 10, those premiums are guaranteed for 10 years. And then what happens is after 10 years, there's an option for you to renew the contract for another 10 years. So it is what is called guaranteed renewable for the next 10 years. And typically, it'll keep renewing until the coverage will end at age 85. There is the option to what is called convert the policy or convert the term insurance into what is called a permanent life insurance product. And the idea is, oftentimes your needs may have changed over time. So let's say you needed that term insurance to cover your mortgage for a specific period of time, whether it's 15 years or 25 years. Loans, let's say you have a car loan. Let's say you're trying to cover for future kids' education, just in case there's something happening prematurely. This product gives you the option to do that conversion to a permanent product so that if you needed coverage on a permanent basis, you have that. And we're going to talk a little bit more about permanent a little bit later on, but that's where Brett and I really work in that space, is mostly on the permanent insurance side. And of course, if you pass away prematurely, then the policy will pay that death benefit out to either your named beneficiary or, of course, to your estate. There's a lot of different markets when it comes to term insurance, and I'm going to highlight a couple of markets. And certainly, I know we probably have a mix of different folks here from different social economic statuses here. So the first one, of course, where we see term life insurance is for families, right? The idea is that if a loved one passes away prematurely, how can we help to maintain that standard of living for the remaining survivors? And I think about, in today's environment, and I know certainly things are tight in terms of cash flow and so forth. Inflation's gone up. A lot of things have gone up in price. And I was thinking about that, what's worse, not having the protection or having the protection so that if something catastrophic happens, at least you have it. Brent mentioned that, he and I have been in the business for the last 25 years or so. And I would say in the last 15 years, term insurance rates has actually come down in price. So name out any other product or services that actually is coming down in price for the last 10, 15 years. And that's term insurance. And that's due to improving mortality. So again, whether you're starting your family or you already have a family, really that term life insurance is going to cover for that immediate needs, to cover you for your debts, your mortgage, your loans, or lines of credit, provide for income replacement. So if my spouse passed away prematurely, at least there's income coming in to continue to pay the bills, maintain that standard of living for my family. And of course, again, it's a true low cost way to cover that. We may have some business owners out there in the audience. And if we do, that's great. Welcome. And think about, when you first started your business, perhaps, cash flow was really tight and you probably didn't have a lot of capital to spend on other things. And this is where insurance will come into play. When you're in that situation, you definitely need that protection, because let's say that you are a key person within that particular business, or you already have a key person. Think about what would happen if you or that person passes away prematurely or gotten sick, as an example. What would be the impact to the business, not only in the short term, but also in the long term there as well? So that's really something to think about. The other part here, of course, is debt, right? So if you have a business that has debt, life insurance, term life insurance will cover that. I think about back during the COVID times, a lot of businesses took on a ton of debt just to keep their business afloat. And I always think about, was that debt insured? And if something happened to them prematurely, are they covered properly? And then, of course, for succession planning. So you may be in this situation right now where you're successioning to the next generation, where that family member is going to take over the business. This is where insurance can help to provide that liquidity, cash flow, so that individual who's purchasing the business has that money available to purchase that business. So that's what it does. The other part here is, if you are about to retire soon, I'm jealous. No, I'm joking. So I saw this stat actually. It talked about mortgages when it comes to pre-retirees. We're talking I would say 50 to 65 plus. So this is from Stats Canada. And From 2016 to 2021, the number of Canadians over 65 with a mortgage has increased from 1.2 million to about 1.5 million. So there's more and more pre-retirees and retirees that actually still have a mortgage right now. Even though the idea is that, you know what, by the time I'm retired, I'm going to pay off that mortgage, but that's not the case. What are the reasons? Of course, housing prices are high, right? So it's delaying paying off that mortgage. Perhaps our children has returned back into the home because they cannot find a home, right? So there's an additional expenses that are incurred for that as well. Increased reliance on home equity. So there's a home equity line of credit. A lot of people are leaning on that to help actually fund their retirement, and also perhaps they're doing something with the home. Maybe they have to do some renovations of the home because someone may be in a wheelchair, for example, and they need a ramp or any other equipment within the home. So they're taking a line of credit. And of course, the affordability challenges. Another product that's out there that's very interesting is something called a reverse mortgage. So the way quickly the reverse mortgage works is that essentially you're just taking basically a mortgage against your house, and then you're receiving that receiving that mortgage tax free as income, and then you can use that income for whatever you wish for retirement. So we're definitely seeing more and more retirees doing reverse mortgages. And again, I think about, is that mortgage insured? And if something happens to them prematurely, what would happen? Whether they'd be able to pay that mortgage off or not. So we do have a full suite of products when it comes to term life insurance. You can see the different options are available based on your particular need, whether you wanted to cover it for 10 years, 15, 20, there's many different options here that's available to you based on whether you want to cover it for mortgage or loan, income replacement. And also we can cover children. That's one thing these term life insurance policies can do, is that they can cover children. It sounds kind of strange because normally you probably do permanent life insurance for kids. But, there's a story to tell there that, looking at term insurance for the affordability factor and later on doing a conversion into a permanent life insurance policy for that particular child. So that's something to look at. One feature that I talked about before is the conversion option. So just to recap that again. So again, if you have a term insurance policy, you can convert that into a permanent life insurance policy for the duration, for the life of the policy until you pass away, essentially. And there's a lot of different permanent life insurance solutions that we have, and certainly out there in the industry. We have particularly 14 different conversion options. So you can do what is called permanent life insurance. There's non-participating whole life insurance and participating whole life insurance. So if you want to learn more about those particular type of products, certainly reach out to your advisors. There's universal life insurance. And the idea here, as I mentioned before, is that you may not need the coverage anymore, that term insurance coverage anymore, because your mortgage is paid off, the kids are out of the home, perhaps, and you don't need that coverage anymore for their education. It's that convertibility where now we're moving into more estate planning for our estate. Perhaps we need that life insurance to cover for any type of future capital gains, because yes, capital gains may come up along the way. Maybe there's some estate costs that are coming up. And also maybe you're charitable. We're going to talk a little bit about charitable giving. Maybe you want to leave a larger gift to a particular charity. This is where that permanent life insurance will come into play. So there's a lot of different options, flexibility that we can do with the term.
Yeah.
Yes.
On the conversion, I know it's on the slide, but I just want to point that out. One of the big benefits is, and as Dawit said, we might start out with term insurance early because we don't have any capital, right? So we're all energy, we're all work, we're all future capital. Like, we're gonna earn that as long as we stay healthy and alive, we'll bring that capital in. But as life goes on, that teetering starts to happen, right? That leverage point starts to shift, and we've got a lot of capital. And so your needs go from typical income generation to protecting, either creating the estate or conserving the estate, as Dawit said. One of the advantages to a conversion is you don't have to have good health. So a conversion is regardless, it's a contractual feature regardless of your health. So if you need estate protection and you have that term insurance in place and you're within the allowable timelines, you can convert that no matter what your health is. And that's, as you're going to see as we go through some of the concepts, that's a powerful tool for you because it allows you to shift the nature of the insurance from what you originally bought it for to now what you need as you progress throughout life. Go ahead, Dow.
No, that's a really good point about the convertibility without evidence of insurability, because sometimes I've seen situations where they've missed a conversion opportunity, right? And they can no longer, and they're no one can get insurance for whatever reason. So it's interesting. Okay, so we're gonna jump right into the case study here. So as Brent mentioned at the beginning, you may have children who are started off and they may need term insurance, or perhaps you may need it as well. So we're just gonna walk through a case study here and just to see the progression of this particular person here. So here we have Camilla. She's 25 years old. She's just started out in her career. She just bought a condo with a mortgage that her family member has helped them with. And her thing is, if she passes away prematurely, she wants to be able to leave her parents enough money so that he can cover her student debt and also pay off the mortgage. Yes, she does have some life insurance through work. Oftentimes, sometimes life insurance through work is either one-time salary or two-time salary, and it may not be enough. And we need more coverage because, of course, the type of mortgages that are out there are getting bigger and bigger and bigger. So based on her needs, we're looking at about $500,000 of coverage for Camilla. And we're looking at a term 10, and it's just working out to actually $14 a month. Very, very affordable for Camilla as she started out in her career, and that's something that she can budget for. So let's fast forward at age 30. So now she has a growing family. She's had her first child, which is fantastic. So now her needs have changed. Right? And the idea here is that she wants to extend her coverage until her child becomes older. So there is a feature that we have, and it's called the exchange option. Okay? So the idea is that if you have a term 10 or term 20, but I'm going to stick with a term 10, she can exchange that term 10 to a term 20 or term 30 or term 65 without providing evidence of insurability. So the idea is that you're just extending that term further down the road and extend it further. So her needs have changed. She needs a longer term. That term doesn't work for her. We're going to switch it over to a term 20, and it's going to cost her about $240 per year. On top of that, what we've done here is that because she has a child, we can add what is called a child rider. So this is basically an extra life insurance protection for the child, so that if that child passes away prematurely, Camilla has money available so that, there'll be costs involved with that, but she can take some time to go through the grieving process. And of course, with that child protection benefit or that child rider, you can convert it into permanent life insurance up to 5 times the amount. So lots of different options for Camilla at this particular age.
And that's a great rider, Dawit. Honestly,
Yeah.
as a father who's exercised that on 2 of his children,
Yes.
your kids can be super healthy, but health changes. It's fleeting and it's gone in a moment. And those riders that allow you to have permanent life insurance where the insurer cannot say no to you, they're absolute money in the bank every time.
Yeah, absolutely. I agree. All right. So let's fast forward. So now Camilla is age 50 years old. Certainly she no longer needs that term life insurance anymore because again, she's switching to a situation where perhaps her mortgage is paid off or her mortgage is paying down over time and she doesn't need as much coverage. But at the same time, she's starting to plan for her retirement. She's thinking about, I need to put a little extra away because I got to start thinking about that. And of course, what might happen after her death, right? Because she still wants to provide that life insurance coverage to her particular family. So what we're gonna do here is that we're doing that conversion option that myself and Brent has been talking about. So yes, she has $500,000 worth of coverage, but you know what? She's decided that she wants to convert about half of it, right? Because you can do what is called a partial conversion. So she's decided to convert up to $250,000, and there are options available where she can go into a term to 100 option. You can see the price here on the screen, or she can get into something what is called participating whole life insurance. So participating whole life insurance is just a plan where basically there's cash values in it, and you can do multiple things with that cash values over a period of time. The term 100 is just straight life insurance. It's just protection for all the way to age 100. There are no cash values in it whatsoever. So that's why you see the price point's a little bit different. But the participating whole life insurance really provides some extra value to Camilla because, again, the death benefit is increasing over time and the cash values are increasing over time. So what does that look like when Camilla gets to age 65? So at age 65, there's upwards of about $120,000 of cash surrender value in that particular permanent life insurance policy. And she's going to be looking at retirement. So Yes, she has her other sources of retirement income. Maybe she's getting CPP at that time. Maybe perhaps OES, or even her pension, or even just RSPs or TFSAs, etc. But this just gives her another option that's available where she can tap into it. So she can actually either withdraw money from the policy to help supplement that retirement income. She can do a full withdrawal. You can do a partial withdrawal, or you can even do what is called a loan. So you can take actually a policy loan against the policy, or you can do what is called a collateral loan, where you're basically leveraging against the policy. So you're using the policy as collateral for a loan. So that's a bit of a more of an advanced topic, but nonetheless, the idea here is that there's several different options that are available for Camilla down the road there as well. And of course, if she passes away prematurely, then that death benefit would pay to her loved ones. So you can see here for the progression of the term, right? We're starting off at a younger age with that term coverage. We exchange it as we get a little bit older. We're looking at the conversion option in our 50s. And of course, that death benefit just continues to grow over time with that permanent insurance. And then if she passes away, that's the amount of death benefit that would be paid to her beneficiary or to her state.
And it really is about flexibility, options, and choices, right? And over the last, Dawit, I'm sure you'd agree with me, we built, as an insurer, the industry actually is building products so much smarter than what we used to build it 20 plus years
Absolutely.
ago. Like, folks, back in the day when you bought a term 10, if you wanted to switch to something, you had to do they had to come stick you with the needle. They had to do everything all over again, right? And it was
Yeah.
horrible. And
Yeah.
so what we found was a way to make sure that as clients' needs change, the products could change with them. They could lengthen the duration. Like here, now we show on a T20, but that could be a T30. Like,
Mm-hmm.
so it's really whatever works for this client. And then once again, that conversion later and the flexibility options and choices to have additional pots of money that you can source. And that 870,000 folks, I'll tell you the way I'm using my permanent life insurance is so that I can spend all of my assets that I've been growing for my retirement nest eggs, spend all of those. Hopefully, by the time the last one of my wife and I pass away, that death benefit will come in and it will backfill and create the estate for my kids. So there's so many amazing options here. But the big thing you want to take away is just because you started with one product doesn't mean it can't morph in to different products as your lifestyle and your budgets change and your needs change.
Absolutely. And by the way, Brent, did Camilla have to go through any fluids or anything throughout this whole process?
Only in the beginning, probably. Only in the
Yeah,
beginning.
may
And
probably, right?
and the nice thing is, remember
Yeah.
that over time, many of us
Mm.
we're chasing that dollar, we're on that grind, and we're trading our health for our wealth. And
Right.
so that's the importance of picking an insurer that not only has a big product shelf, which I guess I would tie back to you saying we have so many options. Sometimes it's almost daunting how many options we have. But the big thing there is making sure that you're with a reputable insurer that's good on paying claims and has lots of flexibility choices and options for you folks because things change in your life. Your budgets change, your needs change, and who knows? Hey, if you're one of those business owners, maybe your business is that's been struggling, all of a sudden it hits and you're going to need that to pay estate taxes when you get down the road.
Yeah, absolutely. Absolutely. Perfect. All right. So the next section we'll be getting into is solving the estate tax problem. So we're going to talk more about estate planning.
First
Just
off,
to oh, go
now
ahead.
let's just say we're not solving all the estate tax problems tonight because
Oh no.
if Dawid and I can tell you one thing, the
Yeah.
Tax Act is vast.
Ah,
And when you try and apply it to your particular situation, there's always things that we come up with, whether it's, as Dawid's going to talk, the need for wills or trusts and all sorts of stuff. So we're not going to tackle the whole thing, but we're going to do a good job on making sure that you understand where this fits.
yeah, absolutely. And it's interesting because estate planning is becoming more and more important for Canadians today. And very quickly, what it is just how you're going to distribute your assets upon death. So that's one aspect of it, and the other aspect of it is essentially, if you become incapacitated, who's going to make that decision for you for your finances and the healthcare on that? And it's interesting is when we talk about wills, and we'll talk about it in just a moment. I was talking to a friend of mine the other day, and I said, when are you going to get your will done? And she said, Donna, why do I need a will? And so she's single and she's got 3 kids. And I said, it's not necessarily about the money. And it isn't. People think that, in order to get a will, you have to be wealthy, you have to have a lot of money. It's not, well, that's part of it. But the other part of it is control, right? Because it's controlling how you want your wishes to be. Because by the way, if you do not have a will, the government has a plan for you. It's already pre-printed. So I said to her, it's important for you to have a will because it's control, as I mentioned. It's what you want. They'll want to know where your accounts are, how to handle your affairs, and she even has a dog. Like how to handle the dog. Who's going to get the dog? And of course, part of it is the power of attorney as well. Who's going to make decisions on your finances and your health if you become incapacitated? So it's becoming more and more important to look at why it's important to have a will as part of the estate planning process. And with that, and this is a survey that was taken a couple of years ago, 58% of Canadians do not have a will at all. And so this is quite interesting. And here are some reasons why they do not have a will, right? So, it's too time consuming. I don't want to think about death. It's expensive. I don't have a lot of assets and I have nobody to worry about, right? And I believe that CAA has a free will kit, and I'm sure they're going to talk about it a little bit later. But wills can cost from either free or all the way up to $1,000 because it just depends on the complexity of your estate. The other thing, as I mentioned before, I don't have any assets to worry about. Again, it's just more than the assets, right? It's about control, right? Again, think about your bank account. Think about your what I call your digital assets, right? Your photos, your social media, that sort of thing. Who's going to administer all that, right? So, and also it's not about assets that you have today, but the will also covers for assets in the future. So certainly something to think about. Most people will think that, I have my two kids, at some point I'm going to leave my assets, maybe split 50-50 to my kids, and then they're going to distribute it out to their grandchildren over time. But really, there's another beneficiary here, and that's CRA, right? Because I always say that the final tax return, or what is called a terminal tax return, that's probably going to be maybe the largest tax bill your state will ever pay in your life. Because that's when everything's going to come due, whether you have a cottage or other assets, investment assets. We're going to talk about, there's a deemed disposition of all your assets when you pass away. That's when the tax bill is due, whether it's capital gains or other types of taxes. This is where the planning helps as we go along with that. And, when we talk about, why it's important to have a will, if you want that control, right? Who's going to get not only your assets, but perhaps you could be charitable, right? If you want to leave some money to a charity, that's possible. I mentioned before that the government does have a plan for you, right? It's called if you die in intestacy. I won't go through the rules with that as well, but really it's a process where someone's got to apply to the courts to actually administer your estate. And it could take like 9 to 18 months to go through that particular process. And by the way, like some banks and some other institutions, they require what is called letters probate or probate in order to release funds from the bank accounts and other assets as well. So very, very important to have that particular will. So these are the most common types of expenses in the will here, in the estate rather. So briefly go through these. So, final expenses. So, some burial costs, whether you want to be buried, of course, or cremation, funeral expenses. Maybe there's some debts that needs to be paid, of course, personal lines of credits, credit lines, etc. As I mentioned, assets are deemed to dispose immediately before death, right? There is a term called a spousal rollover. You may have heard of it, where the idea is that if you're married or common law, if the first person passes away, all of the assets gets rolled over, actually tax deferred to the second spouse, and that's when the second spouse, their estate, that's when the tax bill is going to come due. So there's those costs there as well. There is probate here in Ontario. It's actually called the estate administration tax. So it is really a tax. That's that. The first 50,000 of estate, there is no tax, but anything over that is about 1.5%. But really, when Brent and I work with clients, we don't really focus so much on the probate costs. We actually focus more on the taxes part. We actually focus on the income tax part, the capital gains part, and also the final expenses and liabilities. Because the probate, like I said, the fees the taxes are a lot more than the probate. That's for sure. And then, of course, there's some estate costs. So think about your executor does have the right to be paid, by the way. Oftentimes it's a family member, but they can take payment. And also think about, for example, let's say you have a home and the light bill still has to be paid, the water bill still has to be paid, the insurance policy still has to be paid, right? So there's some extra cost that is associated with that, and of course the lawyer's got to get paid there as well. So when it comes to power of attorney, so very, very important to have power of attorney. There's two types of power of attorneys. I'll help Brent Wayne here as well. So there's power of attorneys for personal care. So if you become, I'm starting on the right, if you become incapacitated for whatever reason, someone is acting on your behalf to make those healthcare decisions. And then, of course, there's a personal power of attorney for property, right? So when we say property, that means your physical property, but also your bank accounts, your financial assets there as well. So Brent, let's talk a little bit more about the power of attorney for property management. I know we talked today about why it's important to have that enduring power of attorney.
Yeah, and I think it's just important for you to realize that I remember when, it was always recommended that you had a power of attorney, but it started to become a real game. Like it was like if you were doing your wills, you have to do your power of attorney. And it's really once again about control. Everything we're talking about is just really measures of control, folks. So it really doesn't matter if it's a trust, a will, or a power of attorney. It's about giving direction as to how you want things to happen. The enduring power of attorney, by the way, is kind of like a big one that we hear about a lot lately. And I would tell you that it's the one that you want to make sure. So you might say, hey, you know what? I got my wills done a decade ago and I'm good. Just make sure there is an enduring power of attorney as a son who has a mother in a long-term care facility. It's extremely important that we have the ability to pay bills on when and dispose of their property and all that fun stuff that nobody wants to go through, but many of us will live through that sandwich generation, and we want to make sure that we're able to treat our loved ones with the dignity of care, and we want to be able to give them the right to make those decisions. So very important that we get proper advice. You can do this stuff online, folks, but if you are seeing a lawyer to get this stuff done, like get it all done at once, and it kind of rolls all into the cost. It's really not a crazy expensive.
Yeah, absolutely. Absolutely. Totally agree. All right, let's move on. So, I mean, certainly as we go through estate planning, there's many certainly different reasons to own life insurance. You can see it on your screen here: income replacement, education, etc., intergenerational wealth transfer. The idea here is that if you do have a will and a power of attorney, I always ask, how is it funded, right? Will there be enough assets in the estate to satisfy the requirements of the will or the power of attorney, right? And this is where insurance can help provide that extra funding for the will and also the power of attorney. So we're going to jump right into a case study here. And so we have a couple here, two kids. They plan to retire the next few years. All their debts are paid off and their expenses are quite low since the kids have moved out. So this is a situation where their kids are not living with them. So and what they're really focused on right now is that, yes, they've had term insurance policies before because those term insurance policies were covering their debts, right? Their mortgage, their lines of credits, income replacement should one of them pass away prematurely. They're putting their kids through school, so they want them to have something in place just in case if one of them pass away prematurely. So now we're into a different phase now. We're into what is called a wealth transfer phase. So they want to transfer their wealth to their children in the most tax efficient way possible. What Brent and I, what we see when we talk to clients is that they're so focused on, I need to have this pot of money. I need to have this retirement fund to go to my kids. And it's like, well, there's another solution that we can do. We can have a life insurance policy on you. And when you pass away, the life insurance policy go to your kids, and you actually can use your retirement fund and actually spend the money. Because we do work with advisors where they're telling their clients, you need to spend the money, right? Because you have too much. And this is where life insurance will help facilitate something like that. So they're into that phase now where they're looking at estate planning, they're looking at protection, the need for final expenses, they need that permanent cost, they need that fixed cost because when it comes to retirement, certainty is very important when it comes to expenses. They want something that complements their investments. So certainly permanent life insurance can be a good alternative or a good complement rather to an investment portfolio. So there's a term called the insurance as an asset class. We won't get into that today, but that's what it does. And of course, there's some guarantees, right? The key word here is that maintenance free, right? In the sense of like, this is my premium, this is how long I'm paying for, and that's that. So that's that maintenance free that they're looking for. So here, of course, they do have a home, no mortgage, as I mentioned. They do have some RSPs, they have some TFSAs. that they're maxing out. So you can see the numbers here in the screen. What we did was we went through and sort of an estate planning process for them. And what we focused on is what would happen on the last to die. So I mentioned before a term called the spousal rollover, where if the first spouse passes away, all the assets gets rolled over tax deferred, not tax free, tax deferred to the second spouse. So really, we're looking at what the estate liabilities are going to be on second death. So we can see here that their assets is going to grow to about $1.4 million in about 35 years. But if the last person passes away, there's going to be taxes due. There's going to be some estate costs that we talked about. There's going to be probate costs, state administration tax, and also there's going to be some final expenses, that burial costs and so forth. So we see here that they need about, let's say, $250,000. So all we've done here is that we've provided them with what is called a joint last to die whole life insurance solution. So the idea here is that when the last person passes away, that's when the insurance policy is going to be paid out to that particular beneficiary or to that estate. So we're starting with just a modest $250,000 to start. By the time they get close to life expectancy, the policy would have grown to about $420,000. So what it's doing for them is two things. That death benefit is keeping pace with inflation, right? So inflation is very important. With that, estate liabilities will continue to increase over time. So it's keeping pace with inflation. And of course, as part of their family, they want to leave something to their children, right? They want to leave that inheritance to their children because, again, by the way, they're spending their retirement assets. They're living their best life as much as possible because knowing that they have that protection in place there. And you can see here, it's that they're able to pay this particular premium there as well. Any other thoughts here on this case study, Brent?
You know what? Once again, it's just about flexibility, options, and control, right? Like, I mean, the other big thing here is that joint last to die policy. There's a lot of different choices on that, but really it's about adding flexibility into their plan. It's about making sure that, you know what, if I pass away, that estate tax gets paid. The other thing too is it allows you to spend down those assets in death.
Mm-hmm.
So if we spend down those assets, now we may not have that tax bill, but that insurance then takes the role of creating the estate. So it's a great option to look at. And as I mentioned a little earlier, that's exactly how I'm building out my estate, is to make sure that it has this sort of flexibility.
Absolutely, definitely. All right. So the next section we're going to get into a little bit here is on vacation property planning. So most individuals think, vacation property is a cottage. It could be a cabin. It could be a trailer. Actually, we know that they've increased in value significantly over the last few years. But when it comes to these type of properties, succession is very important because you may have a cottage out there and you want to pass it on to the next generation. Sometimes it can get complicated, right? Because, families often have to balance that emotional side. So, for example, who really loves the cottage or that cabin with the financial side, right? Because at the end of the day with that cottage, the capital gains tax is going to be due on that particular cottage. So if you want to keep that cottage in the family, will there be enough money in the estate to pay the capital gains taxes on the cottage? And if there's not, this is where life insurance can be used to fund the taxes. Right. So that way it ensures that it passes on to the next generation and hopefully to the next generation after that.
And cottages are like, as you said, it's an emotional attachment thing. It's where all the memories get made. And so people want to pass those memories on, like you're saying, for multiple generations. But it's not just the capital gains tax. It's also the ongoing maintenance costs. Because inevitably, let's say out of my three kids, one of them uses the cottage every weekend. One comes up when they can, and the other one lives out of province. So it's rare when they're there, but it's nice. Inevitably, the guy that likes to use it the most is the one that makes the least and thinks everybody should split the bills. So, you really want to think about the usage of it. And sometimes we're better to leave it to one kid and equalize out that estate. And that's where that balance of planning comes in and making sure that, you know, you know, equal. We're trying to achieve equalize, not always equal, right? What we're trying to do is make sure that we have fair treatment across the kids and that, we don't have to lose this asset from the family. Let's go to that next slide, Dawood, because I think
absolutely. Let's talk about this. Yeah.
Yeah. So, clients have a bunch of different things to consider when they're looking to transfer this, because we know that if we transfer this asset, that's going to trigger a tax bill. So at the end of the day, listen, clients can do absolutely nothing. We call this the ostrich. They bury their head in the sands. They pretend like the tax is never going to be due. And then unfortunately, when that second death happens, the government deems that you sold your assets the day before you died, and the tax man cometh looking for some liquid cash. And so that's not always the best way to deal with this, because we're forced with some things. Number one, we may have to sell it to pay taxes, because if there's not enough cash on hand and the kids don't have the cash to pay that tax, and sometimes the growth in cottages have been absolutely astronomical, that the only way to come up with that capital is to liquidate the asset, which then at that point, did I accomplish passing on those memories and making those memories for future generations? Not really. The other option is, well, I mean, there's a few options here, but one of them is borrowing to pay the tax. Now, we do see kids line up for this, but remember, this is not a guarantee. Just because you have the asset, you're more likely, but banks don't just look at assets, they look at your cash flow too. So if they're already strapped with debt, the kids, and they don't have the free cash flow, this may not be an option, because banks lend you money, but they want that capital back and they want interest with it. So that's an expensive way of paying those taxes. The next one is they can sell it to the kids while they're alive. That's going to trigger the taxes at that point. They're going to pay that. But, once again, do the kids have the cash to do this, right? And do the parents want to give up the control of this asset? Maybe not at that time. If we're 60 something years old, we could save that capital over time. Then when we both pass away, the kids go empty the account, pay the government off. But that's dollar for dollar plus interest. That's an expensive way to pay this tax bill. And when we line all these options up, that last box, folks, buying insurance tends to be the cheapest cost alternative, but there is a caveat to this. Number one, yes, you got to pay premiums. Yeah, nothing's for free in this world. But the biggest expense here is, can you qualify at the time of application? Because if you can't qualify, this isn't even an option. You got to face those expensive options. If it is an option, this is usually your cheapest cost alternative if you have good health to get this stuff. Doubt
Yeah, absolutely. And certainly, as Brent mentioned, these are some considerations that you have to consider there as well. So just to walk through a case study quickly here, this is a couple that do have a cottage. Let's say they have a cottage in Muskoka, and they do have a family home in Toronto. Certainly they do want to keep the cottage in the family as much as possible. And what we came up was basically, they had a tax liability of about $250,000. So that's how much taxes that'll be due on that second death in order to pay the taxes to CRA. So we came up with a solution here where for $250,000, they have two options where they can look at what is called a term to 100 option on a joint last to die basis. So you can see the price here on the screen. Or there's another option where they can actually have it paid up on first death. So what that means is that if the first person passes away, the policy is essentially paid up. So even if they pass away the next day or a week later, that policy is paid up, and then the survivor doesn't have to worry about paying that policy. Yes, it's a little bit more, but it's that peace of mind that they're paying for there as well. So that's that other option that's available to them there as well. One thing to really look at from a charitable giving standpoint is that if you are looking at providing a larger gift to a particular charity that's near and dear to you, certainly there's options that's available to you. So you can donate what is called publicly traded securities, so there's no capital gains on that. You can donate cash. You can actually donate real estate, personal property. But what we're looking at here is life insurance, right? So this is where life insurance can really help to provide that larger gift to that particular charity. There is the option to either have a tax deduction on the premiums being paid either while you're alive, or you can have the tax deduction on the death benefit on passing. So a lot of flexibility there. But if you are interested in looking at how life insurance, again, can leave that larger gift to a particular charity, certainly reach out to your advisors on that. So just to talk about the old style versus new style retirement planning, let's compare some different risks here. What are the chances of a major, let's say, a fire to your home? In Canada, it's about 1 in 1,200 chances that your home will be on fire. What are the risks of being in a car accident? So it's about 1 in 20, or sorry, 1 in 270 rather. What's the probability of dying? That's 1 in 98. And what are the chances of becoming critically ill before 65? And it's 1 in 3. We have insurance on the house. We have insurance on the car. We may have life insurance, but do we have critical illness insurance, right? So it's basically a product where if you have a serious illness where you're diagnosed with a cancer, heart attack, or stroke, it'll provide a lump sum of money to you so that you can pay your expenses there. So when it comes to retirement assets, right, you've built up that retirement assets over time. You have a plan that I'm going to draw down these retirement assets. I'm going to travel. We're going to perhaps leave some money to the kids, etc. What if you're stricken with a healthcare crisis or you have an unexpected illness where you have to tap into your retirement savings? Maybe you need money for transportation, living expenses. You have to do modifications to your home. Maybe you have to go to a nursing home or a retirement home. Maybe a spouse has to take a leave of absence where they have to take an unpaid leave. So what it really does is that these type of expenses here will continue to erode your retirement assets over time. So what we're really looking at here is basically looking at critical illness insurance to cover your particular retirement assets. And certainly if you want more information on that, you can definitely let us know. So just to wrap up here, we talked about term life insurance where it's fairly flexible for your particular needs. There's a lot of different options available at your affordable price point. So certainly your advisors can reach out to talk about that. Very important to talk about estate planning with your advisors, the wills, the power of attorneys. Again, how is the will funded? How is the power of attorney funded? Is there enough assets in the estate or assets in your bank account in the case of a power of attorney to pay for those expenses? This is where either life insurance or a complement of critical illness insurance can help with that there as well. So with that, was there any questions out there? Oh, so go ahead, Brent.
No, I was just going to say, I know folks, we're trying to keep you in time. I know we did start a couple minutes late due. I had some technical difficulties, so I apologize for that. I just want to verse back on a couple of the topics just to slow that down a little bit. So when we're planning for the cottage, folks, there's a thing that we skipped over, and it's principal residence. So as we know, right now, in our current tax system, principal residence is a great advantage to us. We do not pay tax on our personal residence, so that's a good thing. We had an example in there where we show if you bought your cottage and your house roughly at the same time, you do have the choice of toggling between the two. So you can say, hey, I want to make my cottage my personal residence because I've had more growth there. Or you're looking at your house and you're saying, well, my major growth has happened there. So there are some choices when it comes to electing your personal residence. Now, I gave you the example of buying both at the same time. That typically doesn't happen. So you do want to work with a tax professional in that regard when you're doing that form of tax planning to make sure that you know when you're let's say you bought your house and then a couple years later you bought your cottage and you want to switch that. There's going to be principal residence for the period that you own the house as principal residence and period for the cottage. You're going to work with your tax professional on that and figure out what is the best way for you to minimize your tax when it comes to that. The example, Dow, we went into that 250 example of what was owing. And that's because in that scenario, the cottage had less tax than if we had designated the principal residence because the growth was in the principal residence. And so what we're looking at there is creating that cheapest cost alternative for covering that tax. Then you went into the charitable giving, and I just want to highlight most people that do charitable giving, it's because you're giving now. You have a cause that's so near and dear to your heart. And there's kind of two ways that people look at this. Number one, I want to make sure that if something happens to me, that annual donation that I make to that charity that may have helped my mom, my dad, myself, or somebody, that continues because that's important to me. Then they may use the life insurance to cover that. And they may take the tax deduction on an annual basis now, or they may defer that, like Dowett was saying, you know what, I just want to set up the life insurance. And if that can wipe out tax when I pass away, then that's awesome, right? As opposed to just handing it over to the government, it's a way for me to eliminate tax and choose to have my money instead of going to pay additional tax that I've been paying all my life. Now I can do good with it and I can, help my church. I can help my, special interest group. I can help the Cancer Society, whatever it is. So planning is very personalized. I know we sped through that because we're trying to keep things to time, but I really want to slow it down and say, folks, what's most important is you have the ability to decide and control how your assets get dispersed. And the government is going to come to tax some of this stuff. And if you're working with a professional now, what they're going to take you through is an alternative funding, which is you can sell it, you can pay the tax, you can borrow, you can save it, or you can insure. And whatever makes the most sense, and assuming you can qualify if you decide to go the insurance route, the most important is your hard-earned assets and money goes on to the organizations if it's a charity, or to your children as much intact as possible. And there's ways to do this, as I said, with, or as Dalwit was saying, with wills, trusts, life insurance, and other vehicles. But it's most important that you are empowered and you understand the planning that's being put in place. And it doesn't matter whether you have an estate of 50,000 or you have an estate of 50 billion. Everybody wants to make sure that it goes on to the people and that they have the control to make sure that it goes on the way they want. Dawit, anything else?
Yeah, no, you said it best. It's a really good summary that you made. Definitely a lot of different topics that we just talked about, but the key here is like it's about planning, right? Like we have to start. If you haven't started the planning process, now is the time to start that planning process. Work with your professionals to do that.
Perfect. Maybe we'll bring Jared up and see if
Yeah.
there's anything we need to cover.
So there's been a bunch of really good questions. Some of them have been pretty specific. And so I think we've had some of our advisors answering them in the chat, which is very good. And I think it's been so insightful. And obviously, you guys mentioned this, but when you get into high level estate planning, you definitely have to get your accountant involved a little bit because we're talking about terms and capital gains taxes and all of that. And you just want to make sure that you're covered on all of the sides. One of the things that when I first started way back when I first started in the life insurance business is learning about what that deemed disposition was. Because people think I'm going to save all this money and I want to give it to my kids. And this happened in my family at very recently. If you have $1 million in assets and they go to your, not to your spouse, but to your children, all of a sudden that can be a major tax. And anybody who knows, not that I make $1 million a year, I wish I did, but that tax rate is pretty high. You can lose a lot of those assets. And it's about that proper planning to be able to maximize what you want to do, what you want to leave, and how that goes, how that happens. And that's why that holistic approach is really good, where you talk to your life advisor. And I think at the end of this, we're going to be sending out some information. So you have specific questions. You can connect with a specific advisor to be able to answer those. You can also go to our website at caneo.ca, and there's a lot of information on there. But it's super important to get those questions answered. And hopefully, what the advisors will be able to do is really put it into your perspective, because we can talk about situation A, situation B, and that we do that to illustrate points, but they're never really your story. And it's your story that's important. It's about how it relates to you. And I just want to thank Brent and do it about all of the great information. I still learn something every time I hear you guys talk, so I appreciate it. And I do want to be conscious of time as well. So if there are any other questions or people have specific questions that they want answered, I can get them to these two fine gentlemen, and we'll do the best that we can do. And I just want to say thank you very much and thank everybody for attending. And at that point, I think we'll call it a night so everybody can get back to their stuff, and we'll keep you where we said we would.
Fabulous.
All
Thank
right,
you
Thanks,
so
so
Brad.
here,
much.
everybody.